Thank you for joining us on another episode of the Multipliers podcast. My name is Mahdi and I'll be your host for today. And it is my pleasure to introduce our esteemed guest, Blair Thomas, the Chairman and CEO of EIG Global Energy Partners, where we will discuss a wide range of topics such as global energy markets and energy transition. Blair, thank you for joining me in today's conversation.
Good morning. Thank you for having me.
Why don't we start with a brief introduction about yourself, please?
I've spent my career as a specialist investor in energy and energy-related infrastructure. I started out actually a lawyer by training, worked for one of the big Wall Street law firms, had a stint in government, and then moved over to the investing side, coming up on, almost 30 years now.
Wow. You don't look that old.
I feel that old sometimes.
Blair, let's start with a global overview of the energy market in general.
Change, I think, is the single word that applies to global energy markets today. We run a global business. We're invested in 42 countries, again, all in energy and related infrastructure. And the pace of change that we're seeing in the industry globally is really unlike anything I've seen in my career. And we've had periods of pretty profound change. I mean, you think about the shale revolution in the United States, you think about oil embargoes and geopolitics. But what we're going through now is just fundamentally different and an order of magnitude more profound.
And if we talk about, for example, geopolitics, how do you think the Russia-Ukraine conflict, for example, has affected the supply and demand of oil?
Actually, this may be a little bit surprising to some, but I actually think on the supply-demand side, it's only had a marginal impact. It's had a significant geopolitical impact, but if you look at it today, all the molecules that were supplied by Russia before are getting to the market. They're just going to different markets and at different prices. And so what's happened is the traditional energy flows and energy counterparties have changed pretty dramatically, particularly as it relates to Europe. But the quantum of energy sold and consumed hasn't changed. And so one of the things I push back on is this idea that once that conflict finally ends, that you'll have this surge of supply back into the market. I just don't think that's true. I think some of the countries that are the big importers of Russian energy today, think India, think China, I think what will happen is they'll have to pay more because they're benefiting from a significant discount right now. But the quantum of energy, I don't really see changing much.
And how do you see the outlook of the prices for gas and oil?
That's a big question. Oil is a little bit easier than gas. Gas is more of a regional commodity. For oil, my sense is that we're in the near term, the market's more likely to be soft. And by near term, I would define that as the next 6 or 9 months.
Why?
I think because of a couple of things. One is Chinese demand is still not back. It's still at pre-COVID levels. It hasn't returned to pre-COVID levels, and so and parts of the global economy just haven't come back the way we anticipated. And then on the supply side, there's ample supply right now. We're at record production in the United States. You've got the Saudis have circa 2 million barrels a day that they've held in reserve and are not putting into the market right now. And so I think all that is a recipe for near-term softness. Medium term, I'm much more bullish. And it really gets down to investment. The lack of investment by and large across the industry with the possible exception of the NOCs. I think that will show up in reduced production in that medium-term time frame.
And why is there a lack of investments?
Well, there's a whole host of reasons. One, partly is it's a hangover from the shale revolution. The shale revolution in the United States, often talked about, not really well understood. In 2014, I wrote a letter to our investors. So at the peak shale in the United States, and I said that our view was that when the history of the shale revolution was finally written, it would be a geologic success, a geopolitical success, and an investment failure. And in fact, that's exactly what has happened. And so production is at an all-time high. It's had a dramatic impact on geopolitics around the world. But over the life cycle of the shale revolution, it's been an investment failure.
Okay.
Massive overinvestment and a cratering of prices. And so I read a report that Deloitte put out, and they measured cumulative asset impairments over the period from 2017 to 2020. So a 13-year period, cumulative asset impairments in U.S. shale companies, and the number was $700 billion. So a massive destruction of capital in that period of time. And so, again, it had the positive effect on consumers. It had a positive effect on geopolitics. But for investors, it was a bad outcome. And so the consequence of that is the level of discipline that you see imposed today on public companies, particularly in the United States, where investors want to see a return of capital. And so bigger picture, what's happened in the industry over the last 5-7 years is historically we were viewed as a growth industry, and you're investing in undeveloped reserves and exploration, and it was all about inventory. And that's not the case anymore. We've become a yield industry, and people talk about total return to shareholders, and it's about dividends, and it's about buybacks. And so if you're an public energy company today and not paying a high dividend, you have a problem. And so investors are demanding a lot more capital come back to them. And then compounding it is the outside pressure that's being placed on the industry by NGOs and governments that are looking to accelerate energy transition. And one of the ways they're doing that is by curbing the amount of capital that's available to the industry. And whether you see that in banks, retreating from oil and gas investing, you see it in public markets. If you look at public market multiples today for energy companies, they're half of what they were 10 years ago. So if you think about that, you're a public energy company and you traded at 8 times EBITDA a decade ago, you trade at 4 today. If you traded at 6, you're at 3 now. You've got some public energy companies that are trading at less than 2 times EBITDA.
Why is that?
Well, it's again because investors, one, they want to get rewarded. They are investing in a sector that is out of favor. And so to do that.
Can we just go back to the word out of favor? Mm-hmm. Why is it out of favor? Because we need oil and gas.
Sure. But
it's the driver of the global economy.
But I think the whole narrative around the industry has dramatically changed really since COP27. And the idea that energy is part of the problem and not part of the solution.
What problem?
Climate change. And so,
right.
And to be honest, as an industry, we've largely lost that debate. And so, and this is not,
even though it's not true. I mean, sorry, let me just clarify. I'm not saying climate change is not true, because obviously it is. But what I'm saying is the effects of hydrocarbons directly linked to climate change isn't, I think it's over-exaggerated by certain people. I mean, it also revolves around where the Earth is vis-a-vis the sun, because the Earth doesn't move in a sphere around the sun. It moves in an ellipse. So sometimes we're further away from the sun and get really cold times in the period of the Earth. And as it happens nowadays, we're very close to the sun. There are other factors as well. And what are the alternatives? Should we go back to cutting trees and killing whales?
Well, I'm gonna take a little bit more nuanced approach to it. So first, the starting point is, yes, I think the debate over the existence of climate change is over. And again, fortunately in my job, I have the pleasure of traveling around the world and talking to a lot of interesting people. And it's a 90% plus proposition that there's an acceptance of the acknowledgement of climate change. There are pockets of holdouts, but there isn't any issue. And so it's overwhelmingly agreed to.
We agree on that.
There's a general agreement that we should reduce the carbon intensity of society. You can debate about, net zero 2050 and what does net zero mean and all of that. But the direction of travel, I think, is unmistakable. And that's something we support. We've made our own commitments about decarbonization. It influences, again, we invest in energy writ large. So we're one of the largest investors in renewables in the world. We're a large investor in infrastructure. And so we look at the whole value chain. And we try to be kind of apolitical about how we think about this. But whether we like it or not, the people who are opposed to our industry have largely won the debate. And you're seeing that very much so in capital flows. And so the industry does not have the access to capital that it had historically. Once you get below the NOCs and the super majors, that large independent through the small independent, who historically have been the backbone of the industry, and it's where most of the innovation comes from in the industry, that segment is really being cut off from capital. And that's having, big implications in terms of how the industry operates and what it looks like in the future. And that's what leads me to believe that in the medium term, I'm bullish on prices because I think that lack of capital will show up in lack of future production. And again, it's important to remember, that we're in an industry that we have depleting assets. And so globally, writ large, every year, we're 7% smaller than we were the year before. That's the cumulative global decline rate. So if you think about it, 100 million barrels a day of consumption, plus or minus today, if we did nothing, a year...
all you mean?
In terms of the demand side, that's where we are today. Okay. In terms of the production side, if we don't invest, we're going to be 7% smaller a year from now because we're consuming our assets.
Yes.
And so you have to invest to stay flat, much less meet increases in demand. And depending on who you believe, I tend to believe that we have not stopped growing. And so that 100 is going to be 101, it's going to be 103, it's going to be 105. And where does it stop? Is it 110? Is it 115? We don't know until it crests and starts to decline. But we haven't peaked yet. And so we have to invest to keep production up to meet that growing demand. And that investment is, again, when you take out the NOCs and the super majors, that investment is really not happening.
And you had mentioned that investors nowadays, the way that they're viewing this is completely different than they were, let's say, 10 years ago.
100%. And so again, from an investor standpoint, they're doing something that they're going to get grief over. You just look at, BlackRock and what these big asset managers say on the topic is they're tied in knots on this because they're getting a lot of pressure from governments and from NGOs, but they're also stewards of other people's capital and they need to invest wisely. And so the ones who are still investing in energy, and there are many, have said, you know what, I need to get paid more for doing this because I'm getting this pressure. And so return expectations for investors in energy have gone up, traditional energy have gone up, and that manifests itself in lower multiples, right? Your entry price is lower and your overall return is higher. So that's what you're seeing on the traditional energy side.
So should we be concerned about the supply chain in key energy transition technologies?
Yes. Again, I approach this completely apolitical, and we invest around the world, and we're fortunate to have, big investors in all the major economies. The way I look at it is, and I'll use OPEC as an example. OPEC was formed in the early 60s, and it really came into prominence in 1973 in the first oil embargo. And really since 1973, it's had a profound effect in terms of managing prices of hydrocarbons. And OPEC is not a single country. It's, depending on point in time, 8 to 10 countries. And at their peak, they have about a 40% market share. So 8 to 10 countries, 40% market share. At its peak, it's down, 35, 36 now. And they've had a profound impact on prices. So you fast forward to where we are today, you have a single counterparty, a single country that controls about 80% of the supply chain for certain renewable technologies. And so
China?
Yes, China. And so, but my take on it is, I'm not a China basher.
Neither are we.
It's an 80% market share by any one supplier is a cause for concern. It could be France, right? It could be Canada. It could be
Italy.
The most benign country on the planet, but an 80% market share is not healthy. And so yes, we need to pay attention to that. And it's not something that's easy to fix.
Interesting. So in terms of like your energy transition and where you've historically focused on investing in traditional oil and gas. So how is the movement into renewables been for EIG?
Well, for us, the good thing is it wasn't anything new for us. It certainly has more emphasis. We made our first investment in renewables in the United States in 1991. And so it's been part of our portfolios for a long time. 1991.
Wow.
Yeah. And so...
what did it look like back then?
It was a wind investment. And the technology is not that different. Yes, the supply chain has gotten much cheaper, and there have been technology improvements, but it's fundamentally the same thing. It's the same with solar. It's the same with biomass. All these have been around a long time. They just weren't economic, and it was a combination of high costs and lower prices, and so not an emphasis on carbon. And so that whole dynamic has changed, and so we've changed with it. And so low and zero carbon technologies are a significant part of our portfolio, and we have dedicated funds specifically for those activities. So, as I said, we're large investors in wind, solar, hydrogen, carbon sequestration. We've got investments in batteries and EV charging, really the whole gamut of technologies that are low and zero carbon.
Is this the future of global energy demand?
I think it's overly simplistic for people to think that there's a one-size-fits-all solution, and that's really my big concern about the energy transition. Is it's been simplified in two ways that are harmful. One is that there's a single solution, and two, that it's free. And neither one of those are accurate. And that's part of what's causing policymakers and industry people so much angst is that the public perception of the transition is different from the reality.
We've heard a lot of policies being changed, especially in the West, like California. I think they want to have all EV cars by 2035. I don't think that's realistic.
Well, again, there are all kinds of mandates, pronouncements, and targets out there put out by governments around the world. And California is certainly part of that group. A lot of those I take with a grain of salt. At the end of the day, specifically as it relates to electric vehicles, consumers get a vote in this. And certainly right now, consumers are not going along with what policymakers want. It's not that EVs aren't growing, but they're not growing anywhere near the pace that governments forecast. And so I think those targets all end up getting changed.
Let's assume for a second here that EV companies can actually produce enough cars to sustain, let's say, a 100% demand globally. Let's just simplify it and say just California, right? Would the grid be able to charge all of the EVs all the time?
Oh, the grid that exists today, the answer is no. And
even in 10 years?
You'd have to assume massive investment. And part of that is we don't buy the proposition that we're going to go 100% electric on transportation. So one of our investments, we're invested in a company in Chile That's green hydrogen converted into what's known as e-fuel.
Yes.
E-fuel is a zero carbon liquid fuel that runs in a combustion engine. Actually, our partner in that, one of our partners in that is Porsche. And so the Porsche Cup, which is now is part of the F1 series, I think at Monza in Italy earlier this year, for the first time, every vehicle in that Porsche Cup ran on an e-fuel produced by our facility in Chile. And so zero carbon. And the nice thing about that is you don't have to get rid of the combustion engine. You don't have to get rid of all the legacy infrastructure. And so our view is that at its peak, electrification of transport will be somewhere in that 50, 60% range. And the rest will be other solutions like e-fuels.
So what is the cause of this whole narrative change over the past few years? Is it NGOs or is it government? Is it ESG?
It's all the above. And as I said, I think you can...
it's a vilification of an industry that the global economy needs.
It does, but but policymakers don't like it. And yes, they're trying to push industry, and that's fine, right? I think, again, this shouldn't be interpreted as a resistance to change and a resistance to decarbonization. I think those are the right policy objectives. It's just a dose of reality as to what's physically possible and what's not.
Rome wasn't built in a day.
Yeah. And so it's a transition. It's not a light switch. You hear all kinds of versions of that. And so I think the industry, though, does itself a big disservice when it's perceived that we're resistant to change and that we don't think carbon is a problem. I don't think that's not true. That's not our view. We agree with those statements, and we want to be part of that solution. We think we are being part of that solution. But there's also a recognition that, one, the global economy is dependent upon it, and two, if you want to tackle carbon, you go where the carbon is, right? And so decarbonizing and reducing the carbon intensity of the energy system, and particularly how we produce and consume traditional energy, has got to be part of the equation.
So, as you said earlier, like green hydrogen and things like carbon capture. So, are these like new technologies that could be among the solutions for the decarbonization that policymakers want?
They can be. They're not there today.
Okay.
And so, as I said, we're invested in both. Right now, they're not cost competitive. And so you heard a lot of talk in recent years about whether consumers would pay what's known as the green premium. Would they pay more to have something that's zero carbon? And there's some evidence of that, but not of the magnitude that we're talking about. And so again, if you just look at hydrogen, pre-subsidies, the cost of green hydrogen relative to gray hydrogen is about 6 times. And so we're not close. Now, the IRA in the US cuts that in half. And so you start to get closer, but we're at a point now where, again, we have projects that are what are known as, they're pre-FID, final investment decision. The design, everything is done. We're just waiting on an offtake contract. And that's where a number of projects are. And convincing large consumers to sign that long-term offtake contract at a price that makes that project viable, that's the missing piece of the puzzle. And right now, most of them are reluctant to do that. And so we're kind of frozen right now, waiting for buyers to enter into contracts. And, you'd hope that it's done through incentives, but there's some talk in certain countries about mandating it. And so again, my view on this is I always prefer to have volunteers, not hostages. But we'll see where that goes. I mean, I think there's talk that Europe may mandate some of these technologies, which from a decarbonization perspective, you'd think that's progress. But I think you're going to get significant backlash from consumers. Effectively, it's a very large tax that you're putting on consumers. And what I tell our investors is, that I often get asked, what's the single biggest threat to the energy transition? And it's not policy. It's not the industry. It's not resistance to the idea of decarbonizing. Those are all now, we've kind of won that battle. The biggest threat to energy transition is price volatility. Because as you saw this in the UK in 2021,
yes,
post-Ukraine, gas prices shot up, home electricity bills shot up, and you have massive consumer resistance to energy transition. And so somehow we have to fundamentally change our entire energy system over the next couple of decades and do it in a way that doesn't cause dramatic price volatility that causes the consumer to revolt. And I think the jury is very much out whether we'll be able to do that.
So what is the solution? We want to go green, but we still need hydrocarbons. But if we go green, inflation is going to go through the roof.
Yes. And so I'm a believer in an all of the above approach, that we need a diversified energy system, and there should be a variety of sources that support that. I think at the end of the day, the scale of what we're talking about doing in terms of electrification is kind of off the chart. And we've been lulled to sleep as an industry. If you look at the developed world over the last 20 years, electricity demand is relatively flat. And so, we've had modest GDP growth in the developed world over that period of time, but that's been offset by efficiency gains. And so if you look at the quantum of electrons that we needed in the developed world, it's been relatively flat for 20 years. And it's kind of pushed us into complacency. It's the reasons why we haven't invested in the grid and we haven't built new combined cycle gas turbines. All of those are reasons because it was just kind of steady as she goes. Well, now we're electrifying. The key to the transition is electrification of everything we can. So that's increasing demand. We want to substitute out hydrocarbon-based sources of generation. So think coal and gas and diesel. And so that's another source of demand. And now on top of that, you're adding in things like AI, and that demand curve turns into a hockey stick.
I wanted to ask you about the role that AI is playing, actually.
Yeah, I mean, I think it all goes to the demand side of the equation, and there's two pieces to it. You've got the overall electricity demand, which is going up sharply, and then you look at it as how much of that society wants to come from renewable sources, and that's a cliff, and that's just. We're just not going to be able to achieve that in the time frame that people want. And so that's what gives us confidence that things like natural gas is a key part of the solution. We're huge investors in natural gas. I think we're the largest private investor in LNG. And we think that is the key enabler of the transition is natural gas. Now, not every country in the world has access to affordable natural gas. Gas is a regional commodity. It's constrained by transportation. There's all kinds of issues. Those are issues we can solve. But gas has to be part of the equation because otherwise there's just no way. And then again, you layer in AI on top of that and the incremental demand growth from that. And it has to have, it can't have intermittent power. And so that brings us back to gas. In the NGO community, the answer would be no. Okay. I think a number of governments recognize, and the pendulum has started to swing back a little bit, recognizing that there's really no path without it. That's been our position from the very beginning. And the way I describe it is, I don't think anyone can argue but that natural gas is progress. Is it perfect? No. But as a society, we should focus on progress, not on perfection. Perfection is for people who live in ivory towers. For those of us in the real world, progress should be enough.
Agreed. So what is the balance between profitability and sustainability when it comes to your investment decisions?
Now you're really getting to the heart of the issue. And so how do we think about this in terms of portfolio construction, and how do our investors think about this? We're really moving to a bit of a bifurcated market, and what I would describe as a barbell. You've got on one end of the barbell, you've got traditional energy, where, as I said earlier, return expectations are higher. Investors want to get rewarded for doing something that's less popular than it used to be. So return expectations have pushed up. On the other end of the barbell, you have zero carbon and renewables. And one of the challenges with renewables right now is it hasn't proven that it can consistently deliver rates of return that meet investor expectations. So what do I mean by that? If you look at in Europe, if you have an operating wind or solar project, what's the return you can expect from that? Well, the levered IRR for projects like that in Europe today are between 7 and 8% levered. Now, us as a private equity firm, we then, there's a fee structure that's associated with that. So you're talking about net returns of 5 or 6%. And those are equity returns. And there's just not a large demand of capital that is willing to take an equity return for that level of return. And so what do? Well, you invest earlier in the development cycle, you invest in larger platforms. There are a number of things that you try to do to supplement those returns. But at its core, the asset level returns are just simply not high enough. And so why does that matter? When you think about transition, what we're talking about specifically with renewables is in the United States, renewables are a single-digit percentage of the generation fleet. And subsidies like the IRA can be very effective in jumpstarting an industry if you're going from 5% to 10% or 12%. What subsidies don't work at is going from 5% to 50% or 60%. There's not a government on the planet that can afford that. The quantum of subsidy would bankrupt governments when you're talking about something that large. And so the whole idea is the subsidies jumpstart the industry, and then the industry takes off on its own and the subsidies fall away. Well, in order for all that to happen, so the vast majority of the capital that will drive the transition has got to be private capital, right? That's the big pot of money that will solve this. And investors want to invest in transition. They want to invest in zero carbon. They just can't do it at those low levels of return. And so in order to attract the capital that's necessary to drive the transition, again, capital that wants to be convinced, you have to drive up the returns. Investors have to get rewarded for funding the transition.
Take us, for example. I mean, for less than 15% IRRs, we wouldn't invest a dime.
Well, and to be honest with you, I don't think we're going to get to your 15% on renewables. I think for a lot of investors, it's somewhere around that 10% level is where capital availability dramatically increases. Once you start to get into the low double digits, in the single digits, it's just not there. And so that's the biggest stumbling block. And so how do you get those people off the sideline? They have to get, the returns have to go up. How do returns go up? The price of electricity has to go up. And that is not a very popular position to take.
Not just on the consumers.
Well, not just inflation, because inflation doesn't go to returns. Inflation erodes returns. I'm saying
manufacturing.
That the actual sale of electricity has to deliver a margin that allows investors to get something in a low double-digit return. And so to the extent that you have inflation, that makes the problem harder even. Mm-hmm. But the price of electricity has to go up. And that is a very unpopular position if you're a policymaker.
Of course, your constituents aren't going to be happy. And your homegrown businesses aren't going to be happy either.
But I mean, again, I just don't see another way. And then you bring it back to what we talked about earlier about the supply chain, and you want to diversify the supply chain. Well, why is it that a single player has an 80% market share? It's because they're the low-cost provider. And so if you want to reshore some of that business in Europe, in the United States, or other parts of the world, you can do that. But by definition, it's going to cost more, right? And so, yes, you will have more security of supply, but there's a price for that, all of which leads me to believe that over time, electricity prices have to go up.
That's not very popular.
No.
It's a good thing you're not running for the presidency.
Yeah, I don't think I'd be a very good candidate.
How is ESG affecting your investment decisions these days?
Here's how I frame it. Again, we try to be completely apolitical about this, and it's taken on a connotation that I think is unfortunate. If you said to me, do you want to invest in a company that has good governance? I'd say yes. If you said to me, do you want to invest in a company that is good to its employees? I'd say yes. If you said to me, do you want to invest in a company that is efficient and minimizes its carbon footprint? I'd say yes to that too. And so each of the individual components of ESG are things that we consider when we're making an investment decision as to whether or not this is a well-run company. And my experience is companies that are well-run companies tend to be well-run across the board. So if you're good at ESG, you're also good at operations, you're also good at safety, and you're also good at delivering shareholder returns. And if you're bad at those things, if you're bad at governance and you treat your people poorly and you're inefficient, you're probably not a company that we want to invest with. So again, in my view of ESG, those are natural due diligence items that inform how we think. And again, we stay as far away from the political connotations of all that as we can get.
Excellent. As an LP to EIG, this is music to our ears. Just wanted to bring up one more topic, which is the energy infrastructure investment. I think this is a very important topic that we need to go over. So what are your thoughts on that?
Yeah, well, it's really the piece of the puzzle that gets talked about the least is the kind of the backbone of the system that allows all this to happen. You talked earlier about California and electricity demand and transition. No, we don't have the transmission that you need. There's a lot of infrastructure that needs to change. Again, when you think about what energy transition means, forget about, you read about it in the paper every day, but what does it really mean? Energy represents about 18% of world GDP, second largest after healthcare industry. So you're talking about 18% of world GDP where we fundamentally want to change how we produce it, how we transport it, and how we consume it. That's a staggering undertaking. And we've got a legacy system that was built for other objectives. And so much of it has to change to accommodate all the other things that we've been talking about. And that makes for great investment opportunities. As I said, we're huge investors in LNG. Well, fine. Look at Germany in 2021. Russian gas gets cut off.
Yes.
Germany suddenly is in a hole. And what do? They permit and build. They start building LNG import facilities in Germany, and they were very successful at it. They did a nice job at it. But they had underinvested in that for 20 years, and they had to play catch up, and they paid a heavy price to do that. But it's a completely different type of infrastructure that was needed because the market changed. And so that's happening around the world. And it's in electricity, it's in LNG, it's in pipelines. And then you start to think about things like carbon sequestration and those types of things. All of that, CCUS could be as large as LNG. I mean, you think about what the possibility is with carbon sequestration. Because this gets to another point. People misspeak when they talk about net zero. When you look at the IEA forecast for net zero, which is the one that most people use, in 2050, the IEA says the world's still going to be consuming 40 million barrels a day of oil and just as much natural gas as we consume today. And that's in a net zero scenario. So you think, well, how does that zero, right? People think net zero means no hydrocarbons. That's not what it means. Well, you have to have things that remove hydrocarbon or remove carbon from the atmosphere. And to me, the primary technology to do that is carbon capture and underground storage, CCUS. And there's a number of different technologies that you can use. But really what you're talking about is at an industrial facility, capturing the carbon at the smokestack, transporting it and re-injecting it into spent reservoirs and storing it deep underground. And that's a net negative. And that's how you get to a net zero scenario when you still have hydrocarbons that are used for certain purposes in society. That none of that infrastructure exists. All of it has to be recreated. I think CCUS could be huge. We're not there yet. It's not the technology side. Again, it's the offtake side. Until there is either some type of mandate, a large enough subsidy, or ideally a price on carbon, right? There's a market solution to this. If there's a price on carbon, industry will take it from there. And that will incent companies to sign those offtake contracts to do carbon sequestration.
Sorry, what do you mean by price of carbon?
The industry preferred solution to all this is not taxes, mandates, and subsidies. It's saying carbon is a commodity just like anything else. And
carbon trading?
Yeah, and so in Europe, there's a price on carbon. If you have a carbon allowance, if you want to emit more than that, you have to buy an offtake.
Yes,
and there's a market which tells you what the price of that offset costs to go out and buy that right to emit more carbon. Or if you don't use your allowance, you sell your unused amount into the market and you get paid by somebody who wants that. Well, for that system to work, there needs to be a functioning market where buyers and sellers set a price on carbon. It's not a government set price. The market sets the price. And it'll be a function of supply and demand.
So what's hindering that? I mean, if I remember correctly, the first time I read about it was in 2005. The US.
Yeah, okay. The US. Again, it's unfortunate. The industry has been advocating this. It's been perceived in the US as a tax, that this is a tax on consumer. Again, depending on how you structure it, it could be perceived that way. It doesn't have to be that. But ultimately, I'm a big believer in market solutions. And at some point, we have to find a way to execute the transition without the government trying to micromanage the whole thing and pick winners and losers, because we know they're not good at it. And the way to do that, in my view, is you set a price on carbon and then get out of the way and let us figure it out.
Interesting. So in terms of artificial intelligence, do you think that would also be playing a role, for example, in this whole carbon capture thing and then the determining of the price of carbon, so on and so forth? Or
well, I think artificial intelligence primarily will impact the demand side of the equation. And so yes, they will be impacted by others, but the biggest impact of the power demand coming from AI and data centers is the grid. What you do to build in grid resiliency. I think in the near term, what you're going to see are more and more transactions with the big hyperscalers when you do what's known as behind the meter. And so where you actually co-locate your generation with the demand, and you don't go through the grid. You go direct from supply to consumer. And it's not inexpensive, but it's reliable. And until the grid investments are made that allow you to dramatically expand the capacity that can go through the grid, I think you're going to see more and more of that.
We have a tradition towards the end of the podcast, where I ask different questions. But since you're on the podcast, I'm going to also change it up. Sorry, anyhow, I didn't run this by you before. So what advice would you give emerging business people and investors in this sector? Well,
first, I'm a big believer in specialization. That's obviously self-serving because we're specialists, but I do think it just seems intuitive to me, whether it's energy or any other part of life. If you spend all of your time and professional energy focusing on a single asset class, you're going to know a little bit more about it than the generalist. And if you don't, then you probably should find something else to do. And so specialization matters. And then my other advice is to really be an effective investor, you have to be dispassionate. You can't allow politics, and personal preferences and things like that to cloud your judgment. There are lots of personal views I have that may be different than how we invest, but you have to draw that line. And as an investor, you have to be disciplined and make as clear-eyed judgments as you can, and then trust your instincts.
Blair, thank you so much for your invaluable insights. We appreciate you coming on the podcast. And please, when you're in the region next time, do let us know. We would love to host you again.
Thanks for having me.
Thank you for joining us on today's episode. See you on the next one.